the assumption that we won't screw it up by hiring them. And we also make the assumption that they'll live to be 100 or 120 or something, and we buy the business. And that's far easier. It is far easier to tell the great baseball batters after you've seen a couple seasons of their batting than it is to go to college, even college baseball teams or high school baseball teams, and pick out the superstars. The one interesting thing, and I wish I could remember where I saw this study, and it may not even be a valid study, but I do remember seeing something many years ago where they tried to correlate business success with various variables. And they took grades in school and whether they got MBAs and all that sort of thing. And they found that the best correlation was with the age at which they started their own business first. The people that got very interested in starting lemonade stands or whatever tended to have better, that tended to correlate better with business success than other variables. We have found ourselves, we've got a lot of MBAs running businesses for us, but they ran them for a long time before we hired them or before we made the deal. And we've got others that never set foot in a business school. And I do think there's a lot to wiring. I think there's also a lot to working with the wiring you have and developing it over time. I don't think it's all innate, and I don't think you can't improve. I know you can improve on what you're given at birth, but I do think an awful lot of it's wiring, more so than I would have thought 30 or 40 years ago. And I've certainly seen it in business. There are people, no formal business training. Charlie never went to business school. But he thought about it. I've never heard Charlie say anything dumb about business yet, except when he disagrees with me. The truth is, I've never heard him say anything dumb about business, period. And there are other people. I've never heard Tony Nicely say anything dumb about business, ever. They're wired so that it doesn't flicker. They get the answers. It doesn't mean they can, they'd be a great ballroom dancer or a great baseball player or, a great politician, but they are wired for business. Charlie?
Yeah, part of it's intelligence and part of it is temperament. I don't know if Bill Ginn is in the audience, but by the time I was 14 years of age, I knew Bill Ginn would be rich. He was a classmate of mine in high school. He was a very intelligent man, and he wanted to be rich. And he was sensible in the way he handled life. I think sensible people with the right temperament and the right intelligence, if they live long enough in our system, will get rich. But temperament is, I think, to some extent inherited too, don't you?
Yeah. His daughter, incidentally, is a partner with my daughter in a knit shop, which I hope you patronize while you're... We've united again and the Buffett family. Charlie, when did you first think business was something of interest to you?
Very early. I loved games of chance, and I loved trying to learn how to win at them.
Yeah, it's interesting for me, simply to think about the question of whether the Final Four of the NCAA will be canceled as opposed to postponed or transferred in locale, and to decide if we're going to pay out $75 million the next day, if it is canceled, then how much we want to receive in today to take care of that. And that probably wouldn't interest all kinds of people. That wouldn't be interesting to. And since my dad wouldn't let me become a bookmaker, I went into investments. Number 3.
Good morning, Jens from Germany. After buying almost all of Colon Re, how happy are you about the progress, and what are the plans for the remaining minority shareholders?
'80s of Cologne Re, a large German company, that they bought this 80-odd% in a few years earlier. It's actually slightly more complicated than that because there was an arrangement where a certain purchase was deferred. But as a practical matter, they owned in the 80s. Right now, Gen Re owns about 91% of Cologne Re, and that's a subject that obviously it's not pressing with us because we've owned it for 7 years without taking our interest up, except periodically through small purchases. And there's no particular reason to why 100 would be better than 91%. But if the price is attractive and shares are offered to us, we will always contemplate buying it. But it's not key to any strategy. Number 4.
I'm Christian Tockenberger from Switzerland, Europe. What do you think of the two reinsurance, AIG and Converium from Switzerland? Thank you.
Well, I'm going to give you a chance at a second question because I don't really think I should comment on AIG. They have said that they're going to have their 10K. They hope to have it by I guess today. I haven't received any late word whether it's been filed, but they have there'll be more disclosure on the situation at AIG, and I really don't know anything about what will be in that statement, and I'll wait to read it, and I'll read it with interest. But I have no particular insights on that. Converium has had troubles in the United States, has been announced, but they also raised additional money. But again, I don't really have any specific commentary on those two companies. Charlie?
Well, I'll be bold enough to make one comment about AIG. I think whatever comes along, people are going to find that a lot that was very right was done over the years by AIG. There's a lot of ability in that place.
Oh, yeah. It's extraordinary. I mean, Hank Greenberg was he was the number one man in insurance. I mean, he developed an extraordinary company in his lifetime. It wasn't that much when it was handed to him, and he became the most important factor, I would say, by some margin in the proper casualty business. But in terms of evaluating where it stands now and what will be revealed when the 10K comes out, I just have no idea. Number 5.
Good morning. My name's Mike Nolan. I'm here from Montclair, New Jersey with my 18-year-old son, Brian, who's experiencing his first Berkshire annual meeting. My question, and you touched on it a little bit in a couple of earlier questions, deals with the current regulatory environment in Washington, which appears to be growing much more negative on Fannie Mae, Freddie Mac, Farmer Mac, and so forth. What might the implications for the U.S. consumer specifically and the U.S. economy generally be if the GSEs are effectively bridled or significantly restricted from their past charters? Could this prick what you earlier referred to and some private economists are calling a real estate bubble, and what will be the fallout?
Yeah, the GSEs, in effect, expanded their original charter and reason for being. The thought originally was that they would guarantee mortgages, and they had this very limited, I think, $2.25 billion line of credit from the Treasury. But they were brought in to an extent to do what FHA and VA had done for mortgages in their arena, was to give people confidence in borrowing money or in lending money far away from their own geographical location. I mean, when I borrowed money on my house bought it in 1958, I mean, I went down to see Mr. Brownlee at the Occidental Building and Loan, and he knew something about me, and he knew something about my parents, and he knew where the house was and all of that. But as the mortgage market became more institutionalized and it became more, the source of funds became geographically far more distant from the user of the funds, in order to have a market in which would be efficient, the GSEs were a very logical development. And the GSEs came in, Freddie and Fannie, and the idea was that for a fee which used to average about 25 basis points, they would guarantee these mortgages so somebody living 3,000 miles away could buy them through securities and not worry about the individual property. And then the portfolio operations developed over the following years. And of course, they enabled the GSEs to earn high rates of return on capital because, in effect, the GSEs were looked at as government guaranteed so that people would lend them money without worrying about the degree of leverage employed. And in effect, the GSEs became huge, they hugely developed what might be called the carry trade, using the government's credit in effect, and the spread between what they paid on their money and what they got on mortgages. So that became the dominant source of their earnings. They got very carried away with delivering promised rates of growth. I remember reading in the Freddie Mac report some years ago where they talked about delivering in the mid-teens or low teens or something like that. And I thought to myself, that this is madness, because you can't do that when you're running a big carry trade operation. Interest rate, the slope of the curve will develop. There's no way to lend money for 30 years to somebody who can pay you off 30 seconds later to actually match assets and liabilities in a way that's risk-free. The only way you could do it would be to issue a 30-year bond of your own, which you could call 30 seconds later, and people don't buy those bonds. So as a practical matter, you could not perfectly handle the risk of significant interest rate changes. But the GSEs got caught up with delivering increasing earnings all the time to Wall Street, so they first enlarged their portfolios, and later, as we've seen, they got involved in some accounting shenanigans, which really sort of boggle the mind when you think of two of the most important institutions in the country, with all kinds of financial experts on the board and top named auditors and everything, and turning out that billions and billions and billions of dollars were misreported. It shows you what can happen in a system. Now Congress is reacting, administration is reacting, Alan Greenspan's reacting, in terms of saying that, what have we created? What is this situation where these two companies have $1.5 trillion or more of mortgages they own, and people really think the federal government is on the hook, and the federal government wants to say it isn't on the hook, but the truth is it is on the hook. And institutions worldwide own the securities based on this implied promise, and it was all being done just because basically these companies wanted earnings per share to go up. Now they say they did it to maintain an orderly market and all that stuff in the mortgages, but that they were really set up to guarantee mortgage credit. And there's going to be reaction in Congress. There'll be a huge fight. Both of those institutions have been heavy supporters of various legislators over the years. They've got lots of clout, not as much clout as they had a year ago, but they've got lots of clout in Congress. And on the other hand, people have lost faith to some degree in what they've done, and they've also seen the consequences of the government issuing a blank check to two institutions that are trying to produce annual gains in earnings per share of 15%, and doing it by accounting means when they ran out of the ability to do it by other means. So it's something that Congress should be giving a lot of attention to. They can't cut them off, in my view, and I think most people's view. They can't say get rid of your portfolios or anything like that. So my guess is that some kind of a curtailment comes in, some kind of tougher accounting requirements come in, sometimes it may be tougher capital ratios, and that over a long period of time the government tries to figure out something that sort of eases them out of this position where they were basically backing two entities that at times acted like the two biggest hedge funds in history. Charlie?
Yeah, well, he was asking partly is what happens if the government reins these two institutions way in and forces a big reduction in asset base.
I don't think they'll. Well, I don't think the government is going to do something where they sell off hundreds of billions of dollars of mortgages at all. But if they curtail, let's just say they say that from now on you got to operate in a runoff mode for a few years. There are plenty of people out there to buy mortgages. They're already buying the securities of Fannie Mae and Freddie that are financing the mortgages. So it isn't like Fannie and Freddie independently were coming up with the funds to finance these mortgages. They got them from somebody else, and that somebody else can leave Freddie and Fannie out of the picture and buy the mortgages through some other form. It would not be the end of the world at all if Freddie and Fannie no longer had new portfolio purchases. I don't think it would change things in any significant way in terms of the cost of home ownership or anything else. How about you, Charlie?
Well, I agree. I don't think it would have enormous macro effects if future growth were curtailed. I do think a lot of the troubles that came from the large use of derivative books and from Fannie and Freddie both believing a lot of silver-tongued salesmanship from derivative traders. And as many of you know, I think there is much wrong with derivative accounting and derivative trading operations in the United States, and I don't think the full penalties have yet been paid.
When you can have a $5 billion mismark in one direction at one of these, and bear in mind these are among the most scrutinized companies in the world, and with outstanding people on their boards in terms of financial expertise. If you can have a $5 billion mismark in one direction, while at the same time the other one has a $9 billion mismark in the other direction, I would say we've come a long way from Jimmy Stewart and It's a Wonderful Life.
Yeah.
Number 6.
Hi, this is Peter Webb from London, UK. The question I wanted to ask you, I've been an investor for many years and done very well following a similar sort of style to yourself. So thank you for that. The big question I have is...
Would you want to quantify that in terms? I mean, you can always send us a check.
Well, if there's a deal to be had, maybe we can speak afterwards.
Okay.
The question that I have for yourself and Charlie is, over the time I've bought many different companies in the UK and Europe, and I've seen many American value funds buying the same companies, but I see very little activity from Berkshire and its subsidiaries. And I didn't know whether that was a reflection on your views on UK and Europe in the world, whether you just see lack of investment opportunity, is it outside your sphere of competence, or is there some other reason that I see less activity from you in Europe?
Yeah, that's a good question. We own, of course, as you know, 80% or so of Mid-American Energy, which has a very large business in the UK, but that's an operating business. As you know, in the UK, there's a rule that requires reporting when you own 3% of a company's stock, and actually there's some conditions under which the ownership will be reported even sooner than that 3%. There's a provision that I think if there's an inquiry or anything that has to be responded to. So if you take a company with a market cap of 5 billion pounds, if we bought 150 million pounds of it, we would have to report, and that tends to mess up subsequent purchases. So we bought stock, we owned stock in Diageo, which was Guinness at the time. We've owned stock in some other UK companies, but we've thought twice before going over 3% because of the reporting requirements, and then we'd have to report if we were selling and all of that. So that's a deterrent, but it's not an overwhelming deterrent. And if we get a chance to buy a significant piece of something that we think is cheap, particularly if we could buy it in one purchase, but there are a lot of special rules that kick in over in the UK that do not in the United States. Incidentally, there was something in the journal the other day that said that we had to report if we bought over 5% of a company within 10 business days in the U.S. That is not true. That was a mistake in the report. But it is the case in the UK that at 3% reporting is triggered. But we would feel very comfortable with lots of UK businesses, and it'd be the same criteria we applied over here: a durable competitive advantage and a management that we like and trust, and a reasonable price. And we have seen some of those. There was an insurance company in the UK a year or so back that I would very much have liked to have bought, but we couldn't come to terms on price. But we have no bias whatsoever against buying business in the UK. And as I say, at Yorkshire and Northern Electric, we have a business that, as it shows in our report, made close to $300 million after tax. And actually, considering my views on currency, I I'd give a slight edge to buying something where the earnings would be in sterling in the future rather than in dollars. Charlie?
Well, I regard it as kind of amusing that we ended up preferring the currencies of Europe when that's so much more socialized than the United States is. That's a queer occurrence.
Do you actually prefer them or not, Charlie?
Well, we certainly over a considerable period of recent months, we've actually preferred the currencies of socialized Europe to our own currency. I just regard that as an odd occurrence for both of us. That wouldn't have happened.
No. Up till 3 years ago, if I came back from Europe and I had a euro in my pocket, I couldn't wait to run to the bank or someplace. I was afraid it would depreciate before I could get rid of it. But I changed my views a few years ago. We hope to buy businesses and stocks other places in the world, and Charlie mentions the difference in political climate. One thing, you read about slow growth in Europe and Japan and all those, and it's true. But the growth figures that you see are usually not on a per capita basis. And since the population of Europe has been generally very little change, whereas the population of the United States grows 1 or 1.5% a year, if you look at growth figures in the United States and somebody says 3 and a fraction percent, that's not on a per capita basis. I mean, you have to deflate that by the growth in population. Whereas if you read about the growth in Europe, generally, you're dealing with a population base that hasn't changed. So the differences in growth rate on a per capita basis are not as wide as the headlines would suggest. Number 7.
Gentlemen, my name is Mike McCloskey. I'm from Toronto, Canada. My question is, what obligation does a financial intermediary or a party to a transaction have to ensure that the other party to the transaction properly accounts for it?
Well, that question may come up in a very real sense, but we have lots of reinsurance transactions, obviously. Banks have lots of transactions with people. And certainly if you knowingly are doing something that causes a company, are participating in it, you may have very serious obligations on that. But on the other hand, we reinsure hundreds of companies. They have legal departments, they have auditors, and there could be somebody out there today. Well, they could be doing anything with their accounting. It probably wouldn't be limited to the contract they had with us. It might well be other things, but it really gets down to whether there's knowing participation, I would say. Isn't that right, Charlie?
Well, as you say, it's a subject rife with ambiguities and different issues. You have had some bartender liability if you serve a drink to somebody that's already inebriated. Some people say the bartender is liable. On the other hand, radio stations are allowed in America to sell advertising time to people that use it for perfectly obvious fraud, and nobody ever sues the radio station. It's very hard to predict what things are going to get legally shifted around so a supplier B gets liability for his customers' behavior.
Number 8.
My name is Reza Abbassadeh. I live in Sacramento, California. My question is related to the issue of U.S. trade deficit again and its implications on the future value of the dollar. Do you think an individual or a business owner here in U.S. should be concerned about the purchasing power of his future dollar earnings or savings and diversify his or her investments in non-dollar based securities?
I think it's very tough for individuals to either select individual stocks, select individual times to enter the market, select currencies. I think that's a game that they tend to get interested in at the wrong time. There's some adverse selection in terms of when people who do not follow stocks carefully get interested in stocks. And I think that the best investment you can have for most people is in your own abilities. I mean, when I talk to students, I would pay a student. In many cases, I would be glad to pay them $100,000 for cash up front for 10% of all their future earnings. So if I'm willing to pay $100,000 for 10% of them, I'm valuing the whole person at $1 million, just capital value standing there in front of me. And anything you do to develop your own abilities is probably going to be, or your own business is probably going to be more productive for you than starting to think about individually making commitments into foreign exchange. If you have a good business in this country earning money in dollars, you'll do okay. I mean, you may live in a world 20 years from now where a couple percent of the GDP is going to service the debts and the ownership that we've created now by running these deficits. But you'll do fine in America, so I wouldn't worry about that much. Charlie?
Well, if you look at Berkshire, you will find that it really doesn't do much of conventional asset allocation to categories. We are looking for opportunities, and we don't much care what category they're in. And we certainly don't want to have our search for opportunities governed by some predetermined artificial bunch of categories. In this sense, we're totally out of step with modern investment management, but we think they're wrong.
Yeah. And incidentally, we have 80% of our money or more, well over 80%, tied to this country and to the dollar. So it's not like we've left the country or anything of the sort.
But when have you done a big asset allocation strategy?
Never.
Yeah.
Yeah. We end up with peculiar asset mixes. I mean, if the junk bond thing had gone on a little longer, instead of having $7 billion in there, we might have had $30 billion in. But we were doing that simply based on the fact that it was screaming at us. And we do the same thing with equities. I mean, back for many years, we had more than the net worth of Berkshire in equity positions, but they were cheap.
And I want you to remember one of my favorite sayings as you do this asset allocation. If a thing's not worth it doing at all, it's not worth doing well.
Yeah. You can see why Ben Franklin turned the mantle over to Charlie. We're going to take a break now, so you can all go out there and enjoy yourself in the adjoining room and have lunch. And we'll be back here at 12:45. And those in the other room might come back to this area because I think we'll have enough seats for everybody after lunch. Thank you, and I'll see you at 12:45. Okay, we're going to start in just a minute or two if you have a chance to sit down. Okay, let's go to station 9. We will go till 3 o'clock. We'll break until 3:15, when we'll convene the business meeting. No one has submitted any proposals for that meeting, so it may be relatively short. At 4 o'clock, Charlie and I will meet in another room here, I'm not sure where, with any of those of you from outside North America that are here. We would like to especially thank you for coming this long distance. So with that, we'll go to Area 9.
Good afternoon. My name is Ken Goldberg from Sharon, Massachusetts. Massachusetts having the distinction of being the birthplace of Benjamin Franklin. And thanks to New Jersey, the only state in the union where one cannot buy Geico auto insurance. Earlier this morning, you discussed policies that have eroded and that threaten to continue to erode the U.S. dollar. In some of your earlier letters to shareholders, you warned about the dangers of inflation and cautioned that shareholders should fully take inflation into account when evaluating the performance of a business. To what degree do you expect a large decline in the value of the dollar to trigger inflation that would adversely impact Berkshire's equity holdings and its businesses? And to what extent should we calibrate Berkshire's overall performance against the backdrop of a weakening dollar?
Well, we think, by and large, we have businesses that will do pretty well in inflation. But inflation destroys value, but it destroys it very unequally. The best business to have during inflation is one that retains its earning power in real dollars without commensurate investment to, in effect, fund the inflation produced nominal growth. The worst kind of business is where you have to keep putting more and more money in to a lousy business. In effect, the airlines have been hurt by inflation over the last to a lousy business. In effect, the airlines have been hurt by inflation over the last 40 years because now they have to put a whole lot of money in a lousy investment, which is a plane, compared to 30 or 40 years ago, and they have to stay in the game. They have to keep buying new planes, and the new planes cost far more now, and the returns continue to be inadequate. So the best protection is a very good business that does not require big capital investment. And the best investment of all, I mean, if you're the leading brain surgeon in town or the leading lawyer in town or the whatever it may be, you don't have to keep re-educating yourself to be that in current terms. You bought your expertise when you went to medical school or law school in old dollars, and you don't have to keep reinvesting. And you retain your earning power in current dollars. Charlie and I are always suspicious that inflation will regain some of the momentum it had a couple of decades ago. We always think it's in sort of remission. We thought the talk about deflation was total nonsense. And certainly the trade picture is one that you would think would accentuate any inflationary trends that might otherwise be experienced. I mean, obviously, the price of oil in euros has gone up far less than the price has gone up in dollars. And you and I are buying gasoline in dollars, so we have seen a bigger increase in our fuel costs because of the decline of the dollar. If we'd lived in Europe or some other, or Australia for that matter. So inflation is always a factor in calculating the kind of investment, kind of business that we want to buy, but it isn't like it crowds out all other factors. I mean, it's always been with us. We'll think about it always. See's Candy has done fine during an inflationary period because it does not have huge capital investments that have to be made in current dollars. Other businesses we have, for the public utility business, for example, it costs a lot more money to maintain capital expenditures now in dollar terms than it would have 30 years ago. So you have to keep putting more and more money into a public utility, and you better hope that the rate of return allowed is commensurate in times of high inflation, the same way that it might have been in low inflation with a lower rate of return. Charlie?
Yeah, well, so far the facts that are driving the dollar down in relation to other currencies have been restraining inflation in the United States. In other words, it's the competitive export advantages of the other people that have so far restrained inflation here. So it's
Yeah, you're paying less for shoes. We got killed in the in parts of our shoe business. And 30 years ago, of the billion plus pairs of shoes used in the United States, a very high percentage were made here, and now virtually none are. But if they were all being made here, you would be paying more for shoes. There's no question about that. Number 10. Thank you.
I'm a physician from St. Louis, and I want to thank you and everyone here because I'm one of these doctors that really doesn't know anything about money or finance. The money comes in, but I don't know what to do with it. I'm not able to really evaluate the financial strength of a company, but I can evaluate the ethical strength of the company, and that's why I feel real comfortable, I think most of us here, having our savings in Berkshire Hathaway. And
Thank you.
This question has probably been asked in different ways already, but several years ago, a fellow I know who had been manager of Magellan Fund warned that we were going to have a terrible decade or so in the stock market because of all the things people have brought up so far, the increasing interest rates and runaway spending and decreasing dollar and stagflation may be right around the corner, Social Security problems, and even what Charlie Munger referred to is that most of our best and brightest graduates, I find, are going into money management rather than they're not becoming doctors or molecular biologists or PhDs in chemical engineering. And so in view of the fact that a year or two ago, there was still an ebullience of emotion about the stock market going up and making everyone rich just by having their money in the stock market, it seems like that ebullience has dropped, and I'm hearing in anticipation of a bear market. And you wrote, I think several years ago, that it's hard to make money in a bull market, and the real opportunities come in a bear market. So I'm wondering if you would give us a clue as to what your strategies are going to be if it's really true that the market gets dismal over the next few years.
Well, if the market gets cheaper, we will have many more opportunities to do intelligent things with money. Now, whether we'll blow on the money in the meantime or something is another question. But you know, we are going to be buying things, one thing or another, operating businesses, stocks, high yield bonds, whatever. We're going to be buying things for as long as I live. Just like I'm going to be buying groceries.
Longer than that, Warren.
Yeah. Yeah. Charlie is just waiting to take over after I. And I'm going to be buying groceries the rest of my life. Now, would I rather have grocery prices go up or down if I'm going to be buying groceries tomorrow and next week and next month and next year? And the answer is obviously, if I'm a net buyer, I will do better if prices are lower. We're not good at forecasting markets. I mean, knew that we were getting enormous bargains in the mid-70s. We knew that the market went crazy to some extent in the late 90s. But we don't have much. We don't spend any time. Charlie and I spend no time thinking or talking about what the stock market is going to do because we don't know. We do know sometimes that we're getting very good value for our money when we buy some stocks or some bonds, as it may be. But we are not operating on the basis of any kind of macro forecasts about stocks. And there's always a list of reasons. You gave a few. There's always a list of reasons why the country will have problems tomorrow, but there's always a list of opportunities which don't get mentioned quite as often. So we don't sit down and make a list of the bad things that are happening in the economy and the good things that are happening, and therefore expecting the stock market. It might not. It doesn't behave that way, even if you could correctly forecast some of the bad things or good things. Overall, I'm an enormous bull on the country. I mean, over time, this is the most remarkable success story in the history of the world, if you think about it. I mean, in 1790, we had less than 4 million people in this country. There were 290 million people in China. There were 100 million people in Europe. You know, and they all had the same intellect we had. They were in the same general climate. They had lots of natural resources. And 215 years later, those 3.9 million people, I think, actually, have 39 million people, I think, actually, have 30% or so of the world's GDP. So it does not make sense to bet against America. That doesn't mean all our policies are smart or anything, but I do not get pessimistic on the country. I worry about the big worry is what can be done by either terrorists or governments that have access to nuclear, chemical, or biological weapons. But in terms of the basic economics of the country, your children are going to live better than you live, and your grandchildren are going to live better than your children live. And we do not focus on macro factors. Charlie?
Well, I agree with you that the economics of the country are probably going to increase for a considerable period ahead. But I suspect that in very important ways we are at or near the apex of a great civilization.
You heard it here first, folks. If you leave the NCB, nuclear, chemical, biological, but I do not feel that way, but you'll get to see which one of us is right 20 or 30 years from now. I have seen more people pass up opportunities because they get focused on a single economic variable or a single problem that the country faces, and they forget about the good things. I mean, if you can buy very good businesses at attractive prices, it's crazy to say, I think I'll sit this out because it might get a little cheaper next year or something of the sort, and because the world's going to go to hell. We've never operated that. We've never decided not to buy a business we like because of a macro view, have we?
Not yet.
Okay. It's hard to get him to really agree with you. I've been working on it for years. Number 11.
Hello, my name is Randall Bellows. I'm from Chicago, and many years ago, Warren, my wife did a portrait of you drinking a can of Coke. Next year, I'll bring one drinking a can of Bud.
I think you better stick with Coke.
Okay. I would like you to speculate on a couple of questions. The first is, given the competitive disadvantage of General Motors and Ford with their huge health care liability costs for their employees and retirees, what do you think might happen there? Do you think there might be a bankruptcy to get rid of the liabilities or a government bailout? And along that line, Charlie, you spoke several years ago about tort issues. Do you feel there's anything coming in the way of asbestos reform or correction for those issues and the insurance companies that have been paying those billions? Thank you.
Well, I would say that Rick Wagner at General Motors and Bill Ford at Ford both have been handed in the past extremely difficult hands to play. They're not the consequences of their own doing at all, but they have walked into what people call legacy situations, but they have inherited a cost structure brought about by contracts that were put in place maybe decades ago that make it very difficult for them to be competitive in today's world. I mean, just imagine if Ford or General Motors had signed contracts that made them pay several $1,000s a ton more for steel than their competitors did. I mean, people would immediately feel that was untenable. So General Motors and Ford are in the position of having commitments which are in strong contractual terms to pay sums for retired, particularly workers in both the annuity field and in the health field that are staggeringly high compared to some of their competitors. And their competitors can buy steel at the same price, and they can buy aluminum at the same price. They can buy rubber at the same price. And when you get all through with it, if they have huge advantages on the on the health care and the annuity side, it's not going to be a fair fight. And those contracts, to some extent, go back to when General Motors had, for example, 50% plus of the U.S. auto market, and now it has 25%. But I think even if it had 50% today, it would be having trouble. So it's a very, very tough situation. I'm not sure what I would do if you put me in charge of, as Bill Buckley said many years ago when he ran for governor or mayor of New York, they said, "What's the first thing you're going to do if you get elected?" He said, I'll ask for a recount. Well, that's a little the way I would feel if I got elected CEO of General Motors. From the standpoint of the UAW, they have a contract, they made a deal, and they've got $90 billion in the pension fund. It's kind of interesting. The pension fund of General Motors possesses roughly $90 billion. The health care fund has a little more, too, another 20-some billion, as I remember. The whole equity of General Motors is selling for about $14 billion. So after all these years, there's $90 billion set aside for the retirees, and there's $14 billion of equity value that's been heading south for the owners. And it would seem that if General Motors had a steel contract that called for, let's say there's a ton of steel in every car. I'm not saying there is. And they were paying $2,000 a ton over market, or what their competitors were paying. People would say that is not a viable situation for the long term. But they're in a similar situation because of contracts they voluntarily signed. And part of the reason they signed those, undoubtedly, was that they bore no accounting consequences at the time. It's a terrible mistake for managers not to think in terms of reality rather than the accounting numbers. But back in the 60s, you did not have to account for pensions on an accrual basis. And up till the 90s, you didn't have to account for health care, or the late 80s, whenever it was, on an accrual basis. And so people said, well, if we don't have to count it, it isn't real. Well, believe me, it's real. And the managers today are facing the consequences of that. So, they've got very tough hands to play. And, I read about it in the papers. I don't know what's going on there necessarily. But something will have to, in my view, something will have to give in that matter. And before you answer the asbestos thing, Charlie, what do you think about them?
Warren gave a very optimistic prognosis, in my view. I think just because it hasn't happened yet doesn't mean that the problem isn't real. If you jump out of the window on the 42nd floor and you're still doing fine on the way down as you pass the 20th, it doesn't mean you don't have a serious problem. If I were the governor of the United States, or a director of General Motors or Ford, or a family member of Ford, I would want to address the problem right now. I do not think it's getting better, or that Yehudi is going to come over the mountain with a magic wand and make it go away. I think it would be better faced.
You want to try the asbestos? Give us another cheery. Around the office, give us another cheery. Around the office, he's known as Pollyanna.
Well, the asbestos thing has involved terrible behavior by some lying doctors, terrible behavior by a bunch of lawyers who suborn perjury, and gutless behavior by certain important courts, and even more gutless behavior by politicians who take care of themselves first, naturally. And if these are the forces that are bearing on a problem, it's obviously not going to be handled very well. So it's a perfectly terrible situation. You keep hoping that it will be so obviously bad that will finally be addressed. Some of that happened in California. The workman's comp system in California had immense fraud in it particularly egregious fraud by lots of doctors and lots of lawyers and lots of claimants, and it was so awful that it affected the whole employment prospects in California. And with the Schwarzenegger revolution, that was partly corrected. I would say maybe 15% corrected. And but it took
500 push-ups, Charlie.
What?
500 push-ups unless it's 100%.
Yeah, no. So I think that if it gets bad enough, there is some possibility there will be more correction. In a sense, it's totally crazy for a court system to be paying tons of money to people that have smoked 2 packs of cigarettes all their life and have one little spot on a lung that no honest doctor would know what the hell it caused, and they aren't yet sick and they're nearly dead anyway from their other behaviors and longevity. And it's just, it never should have been allowed. But once you get a powerful political force, even judges fear consequences, and it's very easy just to drift along with an evil system. Luckily, we aren't using this particular. There are 2 kinds of asbestos, one of which is virtually harmless, and the other which caused all this damage. And we stopped using the damaging asbestos, and eventually the asbestos problem will go away. But how many people it will leave in some kind of financial wreckage before the storm is over, I can't tell. I don't think the last Indian has bit the dust. Do you, Warren? No, I think that, but the behavior is so terrible. It's that kind of behavior that makes me talk about apexes of the civilization.
Number 12.
Mr. Buffett and Mr. Munger, my name is Mark Rabanov from Melbourne, Australia. I think it's rare for diverse collections of businesses to be successful, and I believe an important part of Berkshire's success has been your skillful oversight of the wholly owned subsidiaries. My question is, what advice would you give to your successor in managing our diverse portfolio of businesses?
Yeah, well, it's a very good point that Charlie and I have been known to rail a bit about companies that go and buy this business and that business, and of course that's exactly what we've done ourselves over the years. I think the motivations have been somewhat different, perhaps, than in many of the cases, and then I think the way we've approached it has been different. We have been reasonably successful, although we've had some notable failures, but we've been reasonably successful in creating a climate where the people who built the businesses continue to run them with the same energy after they sell to us that they possessed early on. And I think that you can find all kinds of illustrations in the histories of businesses that are diversified. I mean, Gillette bought 20-some businesses. I remember back in the 60s, Coke bought all kinds of businesses. And certainly the cigarette companies did, all kinds of people. The oil companies for a while were doing it. And generally the experiences were not very good when they got outside of their own fields. But I think when those companies bought businesses, they really thought they were going to take them over and run them themselves. And Charlie and I are under no illusions that we can run the businesses that we buy as well as, or nearly as well as, the people that have been running them over time. And we don't have group vice presidents in Omaha. We don't have a whole bunch of directives going out. We don't have companies that were run one way and then we're going to run them entirely differently and have them reporting in all kinds of special ways to us, and have a human relations department and a public relations department and the legal department, all kinds of things in Omaha telling them how to run their businesses. We think that can destroy many good businesses. It certainly can destroy the incentive of the people that have already gotten rich to stay around and make us rich in turn. So I think that has been an important difference. I think it's been demonstrated well enough to all of those around Berkshire that it's been a very good place generally, I think, for people in terms of how they feel about working there, and I think they recognize it works. So the successor, to me, will come from within Berkshire. They will have seen how it worked. They will believe in it. They will be surrounded by people who have worked in this manner, and I don't think it will be the most difficult job in the world to keep that engine going down the tracks at 90 miles an hour. I mean, it isn't like they have to create the system. They will inherit a system, and I would be amazed if any of the three successors that we will talk about with the directors on Monday, if any of them would not recognize the inherent special values in the system as it now works and take up one of these other models that clearly has been disasters for one company after another that's diversified. Charlie?
Yeah, I don't agree with you that the success at Berkshire has come from our oversight of the subsidiary companies. It's come from our lack of oversight of the subsidiary companies, and I think our successors will be able to provide the same wonderful lack of oversight that we have provided. And if you're not going to use a lot of oversight, you've got to be very careful in what you bring into your corporate family, and you've got to be very careful in treating honorably and well the people who are running the businesses over which you're not giving any oversight to speak of. And I think our system it's very different from a General Electric system. And I think their system works very well for them, but I don't think it's the only system in the world that works in corporate capitalism. And I think the Berkshire system will work very well after we're gone.
It's a very simple system. I mean, GE works exceptionally well, but when I go back to some of the conglomerates, and that's not a term that I shrink from, but most people do because they think it brings down their PE or something, but we are a conglomerate, and I hope we become more of a conglomerate. We haven't succeeded because we had great complicated systems or some magic formulas we apply or anything. We've succeeded because we have simplicity itself. We take people that know how to play their game very well, and we let them play the game. And it's just worked in one field after another, and every now and then we make a mistake. And there'll be more mistakes made. But make a mistake, and there'll be more mistakes made. But overwhelmingly, it works. And it doesn't require some great business insight or anything like that in terms of whoever's running this place to keep that kind of machine in motion. I mean, it is not complicated. The bigger worry would be that the culture would get with in some way, and people would try to oversteer basically. But that won't happen. Our board won't let it happen, and the ownership won't let it happen. And I think we've got something that'll work for a very, very, very long time. And that's why I'm comfortable with the fact that every share I have will go to a foundation that I care about getting good financial results in the future, and I'm quite happy to have them have 100% of their money in Berkshire. Number one.
Jonathan Mills from London, England. What has been the single best investment of your careers, and why do you consider it to be the best, excluding Berkshire Hathaway itself?
Yeah, well, probably the best investment, if you're talking about business, was getting Charlie as a partner. And he works cheap, too. We've had, you can't measure it by dollar terms because obviously we're doing bigger things now than early on. I mean, Seas was an enormously important part of our success. It doesn't contribute a huge percentage of our net income now, but it provided income that let us buy other things in the past. It taught us a lot of lessons about business, all kinds of things. So probably in terms of what it's done already and where it's going to go over time, probably the single best investment was the first half of GEICO, which we purchased for $40 million. Now, the second half cost us $2 billion. I'm glad I didn't buy it in thirds. But, that $40 million will, for half the company, will turn out very well. But GEICO, some of our businesses have growth potential, some don't. And we don't require growth potential as part of a business. If a business makes good money and we can use it to buy other businesses, one of the advantages of the Berkshire system is we have a tax efficient and kind of frictionless way of moving money to the best opportunities. And GEICO internally